Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Edward Hertzman, founder and president of Sourcing Journal. We're going to discuss the supply chain issue and what it means for holiday 2021. Edward, it's great to have you with us. Welcome back to Trade Talks.
Good to see you again, Jill.
All right, you got it. And with brands like Hasbro and Mattel recently citing low earnings due to supply chain disruptions from the pandemic, will holiday 2021 be not so jolly?
I don't want to seem overly bearish right now, but I think we are going to continue to see continued pressure, caused by the supply chain, really impacting Q4. Whether it's the increase of raw materials, whether it's logistics inflation, whether it's difficulty getting people even into the office to work, these cost pressures are going to put a lot of pressure on a variety of sectors. And also, I think we're going to see empty shelves, which is going to cause lost sales for a lot of these retailers and brands.
How will factors like raw materials being in short supply, you have factories shutting down overseas, and the inability to transport goods require customers to place orders in October for their gifts to arrive in time for the holidays?
Well, it's interesting. If we look at a company like Target, who notoriously started their price match in November, they pulled that all the way up to October 10th. They're basically signaling to the industry, you're not going to get a cheaper price than you are right now. And please go out and buy your merchandise. They also, due to the logistics constraints, you're not going to be able to ship something over to, get it to your house in a week or two. So everyone's encouraging the shopper to go into the store right now. Or if you wait to the last minute, I think this is going to be the holiday of gift cards, because there's just going to not be anything on the shelves.
Yep, I would agree with you there. I mean, we're seeing it happen already, and even just before October. So how about this, Edward? What will cost increases mean for retailers? Will they be able to pass it along to customers, and will that ultimately lead to a lack of sales? Consumers are only going to pay as much as they're willing to do so.
So this is the big question, and I think it's important that we don't speak in generalities, but I'll give you a couple specific examples. Right now, the container prices, which is, let's say on an example for a 40-foot container, was $5,000. Now let's say it's $25,000. If the cost of goods inside that container was $100,000, you just had a 20% increase in your cost of goods. If the cost of goods in the container was $400,000, well, maybe you only had a 5% increase. If the container is $40,000, your margin now is, you just had a 50% increase. So depending on the price sensitivity of the product and what's inside that container, it's going to depend how much you can absorb. 5% we could absorb at the factory level, at the retail and brand level. 20, 30%, that's more margin than most people will make. So I think at the price sensitive retailers, you're going to really start to see it very, very hard to hold prices. The general consensus in the soft goods space is that I think Q1 and Q2 of next year is really where we're really going to start to see prices being passed on, because and it's not just the logistics that's affecting this. Today, cotton hit over $1.08, almost $1.09, which is a 10-year high. So no matter where we look, we have pain points everywhere in the supply chain right now.
Right. Well, it's also a matter of labor, and we'll get to that in a second here. But you brought up gift cards before. Do you think this could alternatively lead to too much inventory or discounting, since the retailers are going to have to take delivery at some point?
So it scares me, because I'm concerned that we really haven't learned our lessons. During COVID, we saw very lean inventory, and for the first time for a lot of retailers, we saw record profits because they were selling at full margin, full ticket retail pricing. Right now, people are taking big bets because the consumer demand is still there. And so they're placing big bets into 2022 and even into 2023. The question, like you're saying, is when this inventory does arrive, and it will arrive at some point, will the consumer demand still be there? The stimulus checks won't be there. Will people be at work? Where will we be in the COVID scenario? I do think that could lead to an abundance of inventory. And then we get back to the discounting cycle, and that could be a lot of pain for the retailers.
Right. Edward, we actually saw that happen a couple of years ago. It was I think it was 2014, 2015, somewhere in there, where we had an unseasonably warm winter. Nobody was buying jackets, and it got passed on to your TJ Maxx's and your Ross stores. It was great for the consumer because they were getting these amazing discounts in February and March, but they weren't selling it in the key November, December timeframe. And we saw exactly what happened to the people not on the discount side of the equation. So my question to you is, to wrap up here, we have labor shortages, which is also creating this situation. How long do you expect, between labor and supply chain shortages, how much longer do you think this can go on? 2022, perhaps 2023?
Great question. And from a logistics standpoint, we're going to see these problems into 2023. I would basically say that until the demand weakens, and that allows the supply and demand equation to really balance out, there's no logical reason why these pain points are going to slow down. Unfortunately, when it does slow down, that's a signal that things are moving in the wrong direction economically, right? But I would probably say it's the second half of 2022 into 2023 when I think things are going to start to go a little bit more under control. But I think, as I said, that's not a good sign for us. That just means that there may be trouble at retail, we could be having a totally different conversation and a whole slew of other problems at that point.
Right, and that's a great point that you make, because you're damned if you do, you're damned if you don't. If you don't have the demand, that certainly is a bigger economic issue. But then if you aren't able to supply the goods, that's equally as challenging. So I guess we have to figure out the manufacturing and distribution process, and do we become more self-reliant and change the global model? And I guess, that's an expensive and tough answer to predict.
I think we have to start looking at different models. If you look at the brands and retailers that are winning today, it's not about the cost of goods. It's about the inventory position and their ability to read and react. If we just look at Shein, right? It's a company that's overnight generated billions of dollars. Now, I'm not going to say they're a good or bad company. I don't know enough about them. But the core of their business is they're rooted in two things: technology and supply chain. They're able to see instantly what the customer wants, and they're able to make that within weeks and ship it directly from the factory to the consumer. The old way of waiting 6 months or a year out, to project out and wait. You have a consumer that wants something in 24 hours and a supply chain that takes 6 months or a year to react to that. That is not the formula anymore. So we have to think about how to change the culture and the way we procure our goods. That is going to be important for anyone that's going to survive in the retail environment moving forward.
Right, Edward, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.